Hey everybody, it's Tuesday, December 4th. This is Rick Mount, Paradigm Mortgage Group, bringing you this week's market update, part of the Mike Hardy and Rick Mount team. There's a lot going on out there, so let's just jump right into it and start talking about what is happening out there. So current news, you can't get away from it. Paralysis by analysis, the fiscal cliff. Everybody's kind of in a wait-and-see mode. Some people are projecting that we're going to get a deal done by the end of the year. Others are saying it won't be good enough. So there's still a lot of uncertainty out there that's controlling the market. There's certain comments coming from people like Warren Buffett that were initially starting to ease people's fears, saying that it won't be as big a deal as people think. But last week it seems like the negotiations may have taken a turn for the worst as the administration laid out its desires that are so far off what their original plans were that it's hard for the other side of the aisle to accept, and it just seems like we're stepping backwards. President Obama is now asking for more tax revenues and increased amounts in spending than he had proposed prior to the election. So a little bit tough pill to swallow for the other side of the aisle. So the ticking time bomb that seems to be the center of the issue is the permanent extension of the debt limit. This allows the president to increase the debt limit at any time he chooses. So a little bit scary depending on what side of the aisle you are. I think it's a little bit nervous for all Americans. Oh, big news in the real estate market, possible changes to FHA. With the grim news 2 weeks ago, U.S. Department of Housing Urban Development, HUD, who's in control of FHA, its 2012 annual report to Congress reported that the FHA Mutual Mortgage Insurance Fund has got a $16.3 billion deficit. So is FHA going out of business? We don't think so, but let's talk about some of the highlights. It's the fourth year in a row the MMI fund has failed to meet its 2% statutory reserve amount. FHA has never had to draw upon Treasury funds for a bailout during its 78 years of existence, but we may be headed that way. The reserves are at negative 1.44% of what it's supposed to have in there. And FHA is a big contributor to the first-time homebuyer funding, and it assures about $1.2 million or 1.2 million total residential loans. That's roughly 15% of all of the U.S. home loans. That has seen significant growth over the last couple of years, as it was roughly 5% of all homes about 5-6 years ago. Here's the problem. More than 25% of the loans made in 2007 and 2008 were seriously delinquent. That's 1 out of 4 people. A normal market is somewhere between 2 to 4%. So 1 out of 4 that was made between 2007 and 2008 is seriously delinquent. And then 2009, 12%. That's more than 17% of all agency loans were delinquent by the end of September. That's a big number. So the losses or the shortage is coming from them having to set aside loan loss reserves for some of this paper or the loans that aren't performing. So just like the federal government, FHA is faced with trying to cut spending or increase revenues. It's likely there'll be another round of premium increases and even some talk of making the monthly mortgage insurance premium. So stay tuned for more information, but it sure seems like your door to FHA homeownership, the cost is going up. So where are rates today with all that going on? Well, let's talk about that. They're still trading at or near their historical lows. The government is obviously creating a great support system with their purchasing of the mortgage-backed bonds. Freddie Mac average posted rates for the regional areas. Average rate for a 30-year fixed-rate mortgage, 3.32 at a cost of 0.8, so just a little less than 1 point cost there. 15-year trading at the 2.64% range at a cost of 0.6 points. So we think they're continuing to trade in that very narrow range. What may drive them is a catastrophic event one way or the other, or the inability to get the fiscal cliff done, or if they get the deal done and there's a big rally in the stock market, it could push rates a little bit higher. So we look at the trading range. This is really a tight range, even though these look like big boxes, but 105.5 to 104.5 is the trading range, and we've seen some improvement over the last few days, but we still exist in a slightly overbought area, which means there's probably a little more room for them to move upward than we would like. So as always, if we can help you in any way, we would love to talk to you a little more about what the market's doing, and if you have any questions, give us a call. Have a great week.